We're really honored today because having this group right now is, again, the presenting companies, okay? Neil and Scott Kaufman have had Hillair Capital for years, one of the most successful groups on the street, good friends of mine and good friends of NIBA. Neil's going to give an overview today, so we're really happy to have him here. So, Neil, it's all set for you.
Great. Good morning, everybody. My name is Neil Kaufman. I'm one of the founders and partners of a fund called Hillair Capital. Hillair Capital is dedicated to making fundamental investments in growing publicly traded companies and actually to private companies that are just in the transition to going public. Our typical bite size for an investment is $4 to $6 million going in on a first investment, and we actually get larger on multiple rounds. We love investing in companies more than once, multiple times. Our structure, like I said, is a fundamental investment. We do things in the form of convertible debentures, but everything has a floor. We don't do any floating transactions. By doing it in this structure into a publicly traded company, it gives us the ability to make decisions quickly and to invest large amounts of capital, like I said, relatively short time. People ask all the time, how long does it take us to do a deal? I always say it depends on the company. Fastest investment we ever did is we met a company on a Wednesday. We wrote the check the following Tuesday. We like to focus, like I said, on fundamental investments. We're looking to finance growth and innovation, companies on the upward swing of their lifestyle cycle. We like to finance catalytic events, things like an acquisition, companies reach an inflection point and it's going into a sales and marketing growth spurt, restructuring out of existing balance sheet issues that we're comfortable with, not just when people say put money in, it has to stay in the company. We've done a lot of restructuring as well. So that's a little bit about Hillair Capital. We've been, like I said, very, very active over the last 5 years. We're growing substantially and looking to put more money to work in this structure. My background, I think, is a little bit, is very helpful, I think, for this. So I actually started off in operations. Before and after business school, I worked for the consulting firm McKinsey, worked for them in the US, overseas, in South America, transitioned into operations in the United States, worked for the internet arm of NBC Television, worked for 3Com, the networking company, where I was responsible for about $400 to $500 million of business. And then from there, I became the CEO of a publicly traded company. And when I look back on my experience, having been a CEO, so for those of you who are CEOs or have been CEOs, I understand what it's like to go to bed at night and have to make payroll the next day, to sign a K and a Q when everybody tells you it's great, then they sign a blank sheet of paper and you have to sign your name first and then everybody else will put it below. Feeling responsible for raising capital. Having my investors go up to them and say, I need $3 million, and they give me $2 million and tell me to work smarter, which means I go to bed and I start fundraising the next morning. So I think I bring a different perspective when we look at the ability to look from a more fundamental perspective at how these companies are growing. One of the things we do say at Hillair, we want to make sure that the company is funded. We don't do any of that jump halfway across the ditch. You need $3 million, we'll give you $2 million. Not only because I think people can't work smarter because they're working, I think, at their peak, but we want, when we make an investment, that the management of the company can get up the next morning and start running the company, not thinking about how they're going to make payroll or how they're going to do whatever needs to be done. I have 2 other partners. One of them, Scott Kaufman, he's here, has a background more in the field of finance. He was a partner at a fund, a very, very successful fund. So he's been in this for a long time. He's actually been a CFO, so he signed the Qs and the Ks, but actually slid them across to somebody else who signed them, and then he signed them second. And our third partner, he's back in San Francisco, where our headquarters is. He was a lawyer by trade. He worked for Jones Day. He helped come out to Silicon Valley and open up their office. He was one of like 3 or 4 lawyers, and then he ended up with like 150 lawyers, and he's moved on, and we're all equal partners. Within Hillair Capital, I'm sort of the front of the funnel of the deal flow. So when opportunities come in, myself and my team, we're the ones that look at them first, make the first cut. Obviously, I work with my team, with my partners to decide what to do, but we're the ones that receive the first introductions, we're the ones that have the first conversations with the companies. So I wanted to lay that out, and I wanted to talk, not so much, I mean, the topic here is accessing capital, but what I wanted to talk a little bit about is what we as investors look for in a first presentation. Because we see 20 to 30 pitches a week. We narrow it down to maybe we'll talk to 5 management teams a week, and we're trying to do, say, 2 to 3 deals a month right now at the stage that we're in. That's 2 to 3 new deals, and then we're trying to do follow-on investing as well. And after having seen so many transactions, I just wanted to come up, and I know that a lot of people here are investment bankers, a lot of people here are companies, but it's incredible how much the companies miss the mark when they make a presentation to an investor. I think the most important thing to people realize when you're pitching an investor is we're looking at many things, like I just said. I don't have time to sit there and listen to a 1-hour presentation about your company, about your pitch and everything like that, because I'm deciding when I receive this, should I go on to have the next conversation? So the purpose of the first pitch, the purpose of the first presentation to us has got to be to get us to the next meeting. And what I'll say, I say this to our companies that present to us, the companies in our portfolio, I say to everybody, your pitch is too long and it talks way too much about the product, the industry. I understand that you're really excited about it, and that's great, and the company should be passionate. But if we look at something and we're interested, and we make the decision to go forwards, then we'll go and we'll have the multi-hour conversations where we'll sit there and just say, okay, tell us now again about your company, tell us about your industry, tell us about your team, tell us in great depth. That's the amount of times you go to a conference and the companies roll through a 30-minute presentation, and they're like minute 29, slide 14, and they're talking about their European potential investment strategy for 2018. That's just absolutely useless. I'm gone. A good pitch, I think, should be about 4 or 5 slides before you get to the ask. Because in my job, I'm selling money, right? And I'm just sort of trying to look there and say, hey, how do is this a place where I'm going to invest my time? And I find way too many of these presentations where I'm sitting there and I'm lost, and I also recognize that the company doesn't help me. It doesn't help me what I'm trying to do. And I think that as people who are advisors to the companies, just look at them, I mean, before they hand the pitch, and just say, it's too long, it talks about the wrong things. So I think the first thing is when companies set up and they have a presentation at a conference, or they send it to us, keep it short. Here's who we are, here's what we do, and then the next thing is, and here's what we want, here's how much money we need. You know, it's a great joke. You know, people come in and they say, oh, how much money do you want? Well, we can take 1 to 2, we'll take 3 or 4, and if you give us 7, we'll take 7. And I said, all right, how about this? You give me 120% of your company, give me a personal guarantee, give me your house, and I'll give you $6 million for your company. Because that's the same flippant answer. When I'm sitting there and somebody says, I'll take as much money as I can get, it means you're obviously drowning, or you have no idea what you're doing, or you have no strategy, or you have no thought and concept. You have no idea what you're doing. So I'll just tell you, when I hear that conversation, immediately goes on mute, I start playing Minesweeper or some video game, and I tell the people on my team, just wave when I'm supposed to talk, because I have no desire to deal with a person that has no idea what they're out there. So when you go through that short pitch, come to a point where you say, here's the amount of money and here's what I need. And then the most important thing that I deeply care about when I look at a presentation, and I don't think I've seen one presentation in 100 that does this. All I want to do is find out how I'm going to make money. I'm not trying to, if you guys saw the Silicon Valley thing, you know, we're trying to make the world a better place by doing DRAM optimization. We're trying to make the world a better place by doing this. We're trying to, don't care. The best presentation I've ever seen is somebody looked up and after about 10 minutes in the presentation, they said, here's our company, here's how much it's worth. Here's what it's going to be worth after this amount of money, and this is why you can invest at this number, and in a year, you should have twice that number. I can't believe, anyone selling any presentation, when they go in and you're selling a product, and would you not go in there and say, this is how you're going to get better by taking my product? But people come to financial investors and expect us to figure that out. And so, spoon feed us. We have short attention spans. We're just trying to figure out how we're going to make money. Again, if we like it, well, even if I've spoken to people that buy more stock over the counter, they say the same thing. Just tell me, I'll go figure it out. I'll spend 10 hours in a company if I think I can make money. But if I don't think I'm going to make money, I'm going to cut off the conversation right now because I got 6 other pitches I got to do. So I think I highly encourage any company or any service provider to get to a slide really fast and say, this is how you value my company. And this is why money in now is going to be worth more money in the future. Another thing that I see, and this is especially dealing with publicly traded companies, is I think, and I will say, by the way, this is where I as a CEO completely failed. I think when I ran the company, I did a great job on the operations side, patting myself on the back, considering I said I sucked on 50% of the business. I hopefully did something well. We were able to take a company that was losing money, that was selling products below the materials cost, and we made a positive gross margin. We actually achieved profitability. Revenues grew from $250,000 a quarter to $5 million a quarter. And that was great. But I never spent enough time on the capital market side of a publicly traded company. You know, you go to business school, and if you get to the point of evaluation of a company, you do your discounted cash flow, you spend all your time on an income statement. And of course, all the investors are going to dig through that and rationally understand how much your company is worth. So why bother go telling them? They'll just figure it out. They'll run their discounted cash flows. And that's just sort of the approach that I took. And this is just not right. I need to spend more time out on the market, going out there and telling the investors, not just trying to pitch stock every 2 minutes. We're going to say, okay, I'm here now. This is where I'm going to be in 6 months. I understand that this is the type of investor you are. You're a structured investor. You're an over-the-counter investor. You're a strategic investor. So here's how we can potentially meet your needs, and here's how we can potentially make money. And I'm going to come back to you in 6 months, and I'm going to come back to you in 12 months. And over time, you're going to see how well I'm performing. And you're going to be able to say, gosh, I met this guy, and 6 months ago, and he told me that this company was losing money, but he's going to restructure the pricing, and he's going to come back and, wow, he really did that. And 6 months later, he told me he's going to get a contract with a Fortune 100 company, and he did that. The problem is I did all the work, and then I showed up and I said, hey, I've got this company, and we did well. And the guy said, great, let me watch you for 6 or 12 months. And I think when we see chief executive officers who spend all of their times on the operations of the company, and we'll get into the part of the conversation, we'll say, so tell us about your capital market strategy. Their eyes glaze over, they look in the back, well, you know, we're going to be operating and performing, and then, you know, we're going to go to a couple conferences and sell some stock. At that point, I realized that this person is not the right person to be chief executive officer of a company. I had a board member, and he used to say this to me all the time, and I really thought he was a complete ass. He used to say, that sounds great, Neil. I love what you're doing. Tell me when you're going to go hire a chief executive officer that you can become the head of sales and marketing for this company. And I just thought this guy was completely off base. And I look back at it, and the amount of times I say that now is just incredible, because my personal opinion, you're dealing with a company, especially a publicly traded company, and you're looking at the chief executive officer. That person's job is to sell stock and hire good people to run the company. If they are spending every minute of the day going to every sales meeting and being in every operations meeting and everything, they're not the right person for the job, because I know they're not going to go sell Wall Street and work with their service providers. They're not going to respect the fact that they have shareholders. And it's great. If you can be Google, wonderful. Don't give any guidance, don't give any presentations, don't do anything else. But you'll see that Google, after a whole bunch of years of doing that, all of a sudden has just adjusted their stock. So I guess you have to think of another company that's not spending time in capital markets. But when I summarize the point, I think, again, the role of the CEO is to sell stock and hire people to run the company day to day. Sure, if there's 1 or 2 huge customers, if the CEO has a specialty background in a certain part of the business, but didn't get more involved. But if the CEO is in everyone, or the CEO is running the operations, or the CEO is running the marketing position, then he or she is just not going to be successful. It's not going to be a successful publicly traded company. I will say it's a little ironic as an investor, sometimes you make more money off of those cases because the person turns the company around and then needs to raise more money, and instead of raising it at a higher valuation, they leave a lot more money on the street. But as an investor in the company, when that happens, then we're in a worse shape. So if people come to us at that point and say, the company's great, but nobody knows my name, we like to invest in those. If we've invested in the company and we're sitting there saying, my God, you have a great company, why didn't we tell people? I said, well, we did a press release, and you know, I sat out at a conference and gave a presentation at Friday morning at 6 o'clock, then we know that's going to be a bad situation. And finally, The other thing that I find lacking in a lot of presentations is an understanding of the cap table and the balance sheet. People love talking about the income statement. They love talking about the future growth. They love talking about what's going to happen next year, how we're going to generate profits, and that's awesome. But we all know, especially in the microcap market space, there's a lot of issues on that balance sheet. It is a lot harder to read some of the balance sheets and the cap tables that we deal with in the sub 100, sub $250 million market cap than it is to read Apple. So Apple's pretty straightforward. It's got a lot of common stock. But here we have convertible notes, we have warrants, we have other rights that are available to different people. And it's, again, we look at a company, we're trying to invest, and it can be great, but if the cap table is completely upside down, there's all these rights, and there's warrants at $2, the stock trades at 30 cents, you know the transaction's going to have huge amounts of dilution. The balance sheet has a whole bunch of investors in it that aren't going to be amenable to making change, that are in a certain different position or a different way. You know, so I would just recommend for people when they're doing a pitch to address the cap table and the balance sheet. And I will say, again, that's another one, 90% of the time, my follow-up conversation, in fact I have one today, is purely about the cap table and the balance sheet. And also, the CEOs very rarely know what it is. So please, if you're a chief executive officer, and that one I could give more as long as you have a chief financial officer who understands that and can stand up and answer those questions. But if the answer is, oh yeah, let me get back to you on that, and it takes 2 days because you realize they're reading through the documents, I mean, it could be an opportunity because maybe they have no idea what they're talking about on the cap table and we could invest at a lower rate, I guess, but it's still challenging because we at Hillair, when we're looking for a fundamental investment, when we're putting our capital out, our typical amortization periods over, let's say, 2 to 3 years, we'd rather have a good company do well at a lower risk than have an opportunity to make an investment in such a way that we can, oh great, we got 20% because the person doesn't know what they're talking about. So the person doesn't know what they're talking about one part of the business, they're not going to know about another part of the business. Best conversations, best deals we have are with really good companies that understand what they're doing, have a really good advisor that's engaged and understands what they're doing. I'd much rather have great counsel, great rank, and an educated company dealing with us. Because you know what? They'll get a better deal with us, but we'll be much happier investing because we think the risk is a lot lower. So again, I'd summarize when people make a pitch, whether it's at a conference, whether it's to investors, whether it's something you email, think about, from our perspective, it's just like selling any other product. Come in there and tell us, get to the punchline quickly, tell us how we're going to make money, tell us all the things that we're going to need to know, make it easy for us. Because as I'm looking through the 20 or 30 a day, as I'm speaking to the 5 management teams, if you can make it easier for me to run downhill to a transaction, I'm just as lazy as anybody else. And I'd actually feel more comfortable with a good company, with a good presentation that knows what they're doing about, where I may not get a screaming deal, but I'll get a really good deal, and I'll sleep a lot better. And that's, I think, been the success of what Hillair Capital's done. I mean, the reason I think our fund has done well is we have a lot of companies that have been successful under that structure, paid us back, and continue to grow. So anyway, that's really, it's not so much access to capital, it's more, you know, what we're looking for. And I can say everyone's probably nodding their head sees that they're doing this, but man, next time go look at the presentations at a conference and think along those lines, you'll realize, I mean, at least this is my opinion, I see these all the time, how much people miss. So that's it. Wanted to make sure I didn't take up too much time. It took me 20 minutes. Anyone have any questions, or do we have to go?
I have a question about, you said you get basically cut to the chase in the presentation, but isn't it also important to establish where you are in the marketplace and what your interests are, your chief, where in the financial markets you are, what your business is, what the tone of your business is, because investors want to track different types of investments. So,
Sure.
So,
right, I wouldn't say walk in there and, you're right, I would use the example of the 30-minute pitch where you're minute 29 and you haven't talked about it, but then the flip side to that is true. If you walked up and said, I need $4 million in a structured note, I'd be like, who are you, what you're doing? So I think that's a good point, but it should really be thinking in terms of slides, 4 to 5 slides. Here's what the company is, here's what our product is or the service that we provide and why it's a competitive advantage. Here's our financials, you know, because I'm not going to know how big you are. You're $1 million of revenue a quarter or $10 million of revenue a quarter. Spoon feed that information, but it really should be 10 slides on your product or service. It should be one slide. And the reality is if you can't explain it in one slide at the high enough level, then you haven't thought through your business. I believe that the company's not, but yeah, it's a good point. It's really not, but it should take about 5 or 10 minutes. That's sort of my gut feel. And the first one. Cool. Great. Well, people are around. I look forward to chatting more.
Thanks, Neil.